Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. For those who are in cool weather, hope you're enjoying the start of winter here as we get our first real cold week here in New York area. Hope those who had a 3-day weekend were able to take advantage of the extra day and spend time with friends, family, and give some thought to different things in their lives. So getting started this morning, January 21st, day after Martin Luther King Day, U.S. markets closed. Equity markets last week had another strong week. Bond market yields relatively unchanged. Got a lot going on in the United States with the beginning of the Senate impeachment trial. We also have the Davos Forum going on, and lots of executives and President Trump making comments this morning. So before we get started this morning, just interesting to think about and take a look at where we may be in the economic cycle, and just to see some of the commentary that's taken place this morning, which is indicative of a market that has already made a large run, and there's lots of uncertainty, and I talk about the stock market in particular, but the bond market's also gone up a lot, and that's what's reflected in those lower yields. But this is a time that's really a great time to have a trusted friend, advisor, professional to bounce ideas off of. Emotions starting to be more difficult to keep in check. And rational thinking, because we are human, is perhaps becoming a little bit more challenging as the stock market in particular continues to go higher. Interest rates remain low, and greed may be making a return into the mindsets of individuals, even though many individuals may think that that may be true, but it may not be true of them. So important to gut check, speak with an advisor, speak with someone who's got history, knowledge of the markets, and just make sure that you stress test your thesis. So just this morning, a few headlines just to demonstrate some of the thinking that is going on in the marketplace, and some of the headlines that individual investors are seeing, and this can impact their thinking. So this morning, Paul Tudor Jones, billionaire, successful investor, at least in the past, was quoted as saying that he called this stock market crazy. The market returns remind him a lot of early 1999. He said, "We are just again in this craziest monetary and fiscal mix in history. It's so explosive, it defies imagination," he said. Asked if he wants to get off the train in the bull run, though, he said, "No, not really. The train has a long, long way to go if you think about it." When asked if there's a curveball out there that could derail this market, he cited the coronavirus, which is starting to impact investors' mindsets just really today, and concerns that virus could be something that could break out to a significantly larger portion of the population. Been a handful of deaths in China, a few hundred confirmed cases, and some are speculating that is one of the things that could derail this market. The other I'll talk about is possibly higher interest rates. Other headlines this morning, J.P. Morgan saying the huge rotation taking place in the stock market isn't even halfway over. Blackstone's Byron Wien this morning sees 3 things keeping the stock market rally going in 2020. And then we get another headline this morning in this one on CNBC. Stocks are the most overvalued since at least the 1980s based on one measure. And then throw into this climate change. Another headline this morning, Greta Thunberg says world leaders are running out of time to tackle the climate emergency. So clearly a time of heightened emotions, and a great time to be able to reevaluate, especially here at the beginning of the year, goals, mindset, objectives, and to make sure that both clients and advisors have meaningful discussions and communication. And speaking of meaningful discussion and communication, going to talk a little bit about best practices when clients and advisors meet. And the number one reason that clients and advisors break up or no longer work together is no different than the number one reason that couples get divorced. And that is poor communication. 8 in 10 advisors in a recent survey said that they believe communicating frequently enough with clients and not doing so is the single most important reason they lose clients. Not communicating effectively, and this is from the advisor's standpoint, and admitting that there may be a deficit, when advisors are asked, they cite the lack of communication is dramatically higher reason that client relationships end, significantly higher than perhaps discussions regarding fees or discussions on returns failing to meet expectations. When professors are asked what they view as the most important skill to have success in the financial advisor industry, no surprise, 78% cite the top skill as advisors' ability to talk and communicate and connect with their clients. What is it that you should talk about when you have these meetings with clients, and what should clients expect when they're having conversations with their advisors? And the number one thing to do, and this goes back to the discussion a few minutes ago, that advisors should focus on is level setting expectations. Very often when emotions run high or emotions run low, we need someone on the outside, a third party, to help stabilize the ground and level set what is taking place so that those emotions don't run too high or too low. So, in discussions, advisors and clients should, number one, discuss performance relative to client goals. It should not simply be a discussion of what the actual performance is. Mr. or Mrs. Client, your portfolio was up 17% last year. That's fantastic. Yes, the S&P was up 30%, but let me explain to you why you're up 17%, because you had this much in bonds, this much in cash. That's all a nice discussion, but the discussion should be brought back to here's what your goals are, here's what you're seeking to achieve, here's why the portfolio is structured this way, is this structure still correct? Relative to the structure that we established, here's why or why not we had a prosperous year. Not dragging the discussion down to benchmarks and to performance, but performance and benchmarks relative to client goals. Number two, make sure that there is a clear understanding of what's taking place in the family dynamic. Has anyone's health changed? Is there a marriage, a divorce, a birth in the family? Sometimes this information is volunteered because clients are very effusive and their personality is outgoing, and sometimes you just simply have to ask in order to be able to factor that new information into the equation. Also, have a discussion, just like we had this morning, about the market environment and macroeconomic conditions. One of the biggest mistakes that individual investors make is having unrealistic expectations, and perhaps that is one consequence or one issue. The second is making emotional investment decisions. So by having these conversations, having these discussions, you can often get in front of an emotional situation, a decision based on emotions. I want all in, I want all out, and be able to, again, go back to what are the goals. Also have a conversation, again, what are the expectations, and are those expectations realistic? Expectations are the market was up 30% last year. I'm not greedy. I'll be happy, if my portfolio does 15% a year for the next 10 years. Is that realistic? Perhaps relative to 1 year it might have been, but is that realistic ongoing? Got to have that conversation. You might be surprised what you hear, both from an advisor and from a client, what they're thinking. And then review the assumptions of a plan. What do you think inflation's going to be? What do you think the returns of your portfolio are going to be? How realistic are those expectations? They could have a big impact 10, 20 years out. And then finally, and perhaps most importantly, the purpose of clients and advisors talking is to get to know one another. And once you're able to understand one another, you can have a much more fruitful, meaningful relationship. You can be able to incorporate personal values, personal thoughts into conversations once advisors and clients get to know one another. So very often what some may view as small talk is perhaps the most meaningful or most important portion of a conversation as people get to know each other better, and they can then better help one another. So moving on to the markets this morning, I'm going to talk a little bit about what's gone on this morning. Also going to discuss some ideas from Barron's. Got some interesting ideas from the roundtable where different market experts gave their opinions on perhaps the best place to be in the markets. And then I'll turn things over to Brad to talk about what's going on in the bond market. So this morning I mentioned earlier perhaps the newest item affecting the markets and getting a lot of attention this morning is the coronavirus, which claimed its sixth victim as holiday travel really begins to pick up in China because of the Lunar New Year there. And that is having an effect, especially in the Chinese markets, where the Shanghai was down 1.4%, Hong Kong was down 3%. Lots of memories back to SARS, and some are speculating this could be as deadly, if not more deadly than SARS. Really not a lot known yet, but concerns after the Chinese said that they do believe that human-to-human contact and transmission is possible, and citing that 15 healthcare workers had contracted the disease, which is a pneumonia-like illness. This morning, President Trump was speaking in Davos, and he touted the success of the U.S. economy, and he criticized the U.S. Federal Reserve for keeping rates too high, made some comments and some half-hearted jokes with respect to negative interest rates and how he would love to see negative interest rates here in the United States. Apple in the news, they dropped plans for encrypting backups after the FBI complained. So Apple was going to encrypt backups for customers using their iCloud service, and the FBI said that would harm investigations, and therefore Apple has dropped those plans. This is despite the fact that Apple and the federal government have been butting heads regarding unlocking an iPhone, but here Apple acceding to law enforcement's requests. U.S. Treasury Secretary Mnuchin this morning said a Phase 2 deal with China may not remove all tariffs. That was in an interview with the Wall Street Journal. Taking a look at some other markets, the Nikkei also on some of those coronavirus concerns, down just about 1%. I believe someone in Japan did contract the virus, and concerns there growing. We are seeing strength in the bond market this morning. 10-year Treasury yield down to about 179. That's down about 5 basis points. The 30 years at a 225. The 2 years at a 154. So seeing strength there. Oil down 70 cents, over 1%. This all tied to concerns about that coronavirus, perhaps less demand for travel if the virus is truly spreading. That's leading to weakness as well in stocks that are in the hospitality industry, the airline industry, cruises, anything where people would travel, be in close proximity, concerns that they will not engage in those activities, and therefore that would certainly more significantly impact companies catering to moving people around the globe. Other things to keep an eye on. Today we get earnings from IBM, Netflix, United Airlines. Also today, the Bank of Japan announces its monetary policy decision, expected to keep short-term rates unchanged at negative 0.1%. Tomorrow, earnings from Abbott Labs, Johnson & Johnson, Texas Instruments. We get the National Association of Realtors reporting existing home sales for December. looking for a 1.5% rise after a decline in November of 1.7%. Also get the Federal Housing Financing Agency releasing House Price Index for November. Moving on to Thursday, we get lots more earnings. We get earnings from American Airlines, Comcast, Intel, Kimberly-Clark, Procter & Gamble, to name a few. Big event on Thursday is the European Central Bank announcing its monetary policy decision. We get President Christine Lagarde, who recently replaced Mario Draghi in November, is widely expected to announce that interest rates will remain at negative 0.5%, and markets will be paying close attention as they are expecting Ms. Lagarde to shed some light on the strategic policy review the ECB is undertaking. That's the first strategic policy review since 2003, and this review is expected to address questions like the continued viability of negative interest rates and how the ECB should best address persistently low inflation. Friday, we get many markets throughout Asia, including China and South Korea, being closed in observance of the Lunar New Year, which falls on Saturday, January 25th. Taking a look at financial markets last week, we had markets significantly higher. This morning, futures slightly lower, well off the worst levels of the morning at the moment. Seeing S&P futures right now down about 10. Dow futures down about 55. Last week, S&P was up almost 2%, Dow up almost 2%, NASDAQ a little over 2%, outpacing foreign markets and emerging markets, which are up about 1%. Year-to-date, the 10-year Treasury is up about 1% as well, so bonds continuing to hold up even as the equity markets move higher. Barron's ran a headline story, optimistic. The Dow could hit 30,000 5 years ahead of schedule, and they said they do not expect it to stop there. In 2017, Barron's predicted the Dow would hit 30,000 by 2025. They acknowledge that they may have been underly optimistic, and now saying that it could hit that target 5 years ahead of schedule. Saying that they think that the major reasons for the rally that are taking place are a response by investors to a set of conditions: low interest rates, muted inflation, and massive cash returns from U.S. companies, which is putting cash into stocks as being the most rational thing that investors can do. Not too long ago, there were concerns about the Federal Reserve perhaps continuing to raise interest rates, and Barron's speculating that in October, when Fed Chairman Jerome Powell said he would not raise rates until inflation started heating up again, that was the item that was giving investors some pause, and that was now put aside, those concerns about those rising short-term interest rates. And Barron's goes on to say that rising inflation, which is the number one factor there that could derail the equity markets in the opinion of Barron's, and Barron's suggesting that at least at the moment they are not seeing wage growth exceeding 3%, and the 10-year Treasury, which they view as the best proxy for expectations of inflation, remains relatively unchanged since the year began at about 1.8. I mentioned the 10-year Treasury yield actually even a little lower this morning. So Barron's suggesting that if you are focusing on what could derail this market, what you want to focus on, in their opinion, is taking a look at that 10-year Treasury. If you start seeing rates tick higher, that would be, to them, the first warning sign that perhaps the equity market could be vulnerable or susceptible to a pullback. Barron's discussing one of the motivating factors for the rise in equity prices is the fact that yields in bonds, as many investors and advisors know, is puny and getting punier as riskier fixed income assets have less of a spread to treasuries, or in other words, you're getting paid less to take on that risk, and therefore some of that desire for yield, or some of that desire to chase extra risk, is moving to the equity markets, where perhaps you're getting rewarded a little bit more handsomely, and that's also help driving up equity prices. 80% of companies in the S&P 500 are currently presenting a cash return higher than treasuries. and that's when you take a look at dividends and stock buybacks. On the concerning side is the PE ratio, which is 18.9, which is the highest PE ratio we've seen since the dot-com bubble. So some things to keep in mind. Some other thoughts on the recent market gains. The S&P 500 has gained 15% from October 2nd, which is its weakest point in the fall. And that gain is through January 16th. That might seem impressive, 15% in just a little over 3 months, but if you look at history, it's not spectacular. The S&P 500 gained 35% in a similar 74-day stretch in 2009, and it gained 29% in a 74-day stretch all the way back in 1999, and that is in January 1999. They say the recent 15% rally is similar to gains that we saw in the markets in 1997 and 1968, which were towards the end of bull markets, but not at the end of bull markets. Also, Barron's citing the relative strength of the financial markets. We have the S&P 500's 20-day moving average has now gone up for 61 straight days. The 50-day moving average has gone up for 67 straight days. The 100-day moving average has gone up for 97 days, and the 200-day moving average has gone up for 148 days. Well, all of that is concerning in the sense that the trees don't grow to the sky. Nevertheless, when we have seen such strength has begetted strength in the past, and when we've seen strength that was commensurate with strength like this in moving averages, the S&P 500 has gained a median of 11.6% 1 year after such occurrences. There have been 11 times that's happened, and of those 11 times and that 11.6% average, there was one negative episode, and that negative episode was in April of 1987, 6 months before Black Monday. So moving on to a couple of other stories in Barron's, a couple of individual stocks. Barron's talked about Comcast, and Comcast at the end of last week rolled out their new service called Peacock, which is a streaming plan. And Barron's had a favorable discussion regarding Comcast's presentation as well as its rollout of Peacock, which is a streaming service coming in April. What Peacock plans on offering for no cost if you're a Comcast or Cox Television subscriber customer, or $4.99 a month if you are not a Comcast or Cox customer, will be that you will get Comcast original movies, premium movies, 4K resolution, the ability to watch Tonight Show at supper time rather than bedtime, and full catalog of Universal Pictures movies. That will either be $4.99 or no cost if you're already a subscriber. And that service will come with 5 minutes of advertisements per hour. If you want to get rid of the ads, that's an additional $5. For both Comcast customers and non-Comcast customers. What the analysts appreciated or liked about this rollout is that the expectation is that this is about a $2 billion rollout, and then they expect in the next couple of years for this project to break even on an earnings before interest, tax, depreciation, and amortization basis. To put that cost into perspective, over the same two-year timeline, where Comcast is investing $2 billion, Netflix is expected to invest more than $20 billion. Also on the positive side for Comcast, Wells Fargo analyst quoted that even if you don't choose their streaming service, the fact that streaming is gaining popularity is a positive for Comcast because they are the largest provider of broadband to customers who then utilize streaming services, whether it's Peacock or Netflix or Hulu or Disney or any of the other services. And this Wells Fargo analyst mentioning that broadband customers are 20% more profitable if they strictly use broadband than if they also are choosing to get cable services from Comcast. This is exclusive of Peacock. Because what they typically do when they cut the cord is they upgrade their broadband service to higher speeds, and those higher speed customers are far more profitable. So in a sense, analysts suggesting that heads Comcast could win and tails they could win as well. Barron's had their roundtable, and they mentioned a few individual stocks that I thought were interesting, some on the positive, some on the negative. One company that was mentioned positively was a recent IPO. Thought it was an interesting story. It's a foreign stock, and the symbol is XP. That's X-ray Papa. Went public in December. And what XP does is they are, some calling it the Charles Schwab of Brazil. And analysts are citing that Brazil, in terms of financial services, is not that far back from where the U.S. was in the mid-'70s when Charles Schwab disintermediated financial services by allowing clients to invest directly at relatively lower costs. That's, of course, led to a tremendous change in how financial services are priced in the U.S. But analysts suggesting that XP could be the disruptive force in Brazil. Currently, 90% of financial assets in Brazil sit in proprietary products. That's perhaps similar to what we saw in the U.S. 30 years ago. But XP is in the process of changing that with their open platform. They have 6,000 financial advisors, 120 mutual fund options on their platform. They also have lower fees than the existing banks. Right now, XP has 4% of the Brazilian market, but it's capturing 25% of new asset flow in Brazil. Last year, revenue grew about 90%. And Harry Ellenbogen, who is the person considering XP in this article, suggests that the stock can trade at 20 to 25 times earnings, and saying that if they continue to grow and achieve that multiple, he thinks the stock could double or triple over time. Obviously, that's his opinion. But nevertheless, thought I would share it with you. Also, in the roundtable, there was a woman, Rupal Bhansali. She talked about Subaru, symbol Frank Uniform Jack Hotel Yankee, in the auto sector, which is a sector that is extremely out of favor. But she mentions that Subaru is doing well. There are concerns about electric vehicles, of course, auto sales peaking, trend toward electric away from the combustion engine. But despite all those concerns, she suggests considering Subaru as one of the lowest cost producers, and Subaru is also one of the most profitable with 9% margins. Also, Subaru is trading at around 9 times earnings, growing market share, 5.4% dividend yield, and 30% cash to market capitalization rate. The same young lady also suggests taking a look at BIDU, BIDU, the Google of China, some call it. Stock about 50% off its 2018 high. Some are suggesting that BIDU got TikToked. TikTok is a hot new app that you or your kids may know lots about, but TikTok added lots of ad inventory as their platform grew in popularity. But Barron's and this lady suggesting that that inventory has now been absorbed, and that BIDU trading at around 14 times next year's earnings, which is low by historic standards, and consensus estimates are expecting earnings to rebound about 25% over the next 2 years. Moving on to the bond market. I'm going to turn things over to Brad in a second, but I will mention Bloomberg article in the Bloomberg that Brad had sent out this morning, and it talks about municipal bond yields sinking to 1950 lows. You could take a look at this article. Last time municipal bond yields were this low, Dwight Eisenhower was president. Elvis Presley had just released his second album. To give you some perspective on how low interest rates are, the bond buyer 20-year index of GEO bonds reset at 2.56% this week. And this is happening as massive amounts of money are flowing into mutual funds, which are driving absolute yields lower. And these mutual funds are not chasing the shortest duration, but rather they are starting to chase longer dated debt as investors hunt for bigger payouts. To put the amount of money flowing into mutual funds into perspective, investors added $2.3 billion last week into municipal securities mutual funds. That is the 54th straight week of inflows. Some are suggesting that municipal fund flows have been so strong because individuals, when they look at individual bonds, are so shocked by the yields that they still want to invest in municipals and move to the mutual fund arena. But the reality is those mutual funds are purchasing the same bonds that those individual investors are looking at, but perhaps the yields look more attractive because they're looking at distribution rates, not yields to maturity. The article suggests that despite the super low yields, it is possible that if funds continue to flow into the municipal space and the Treasury yields don't tick up significantly, that you could even get down to 2% yields on long-term munis. Time will tell. I'll turn it over to Brad, who perhaps could shed some more light on where he thinks things are going. Good morning, Brad.
Morning, Keith. Good morning, everyone. Thanks. I hope everyone had a great long weekend. Just a couple of anecdotal stories this morning. Over the weekend, ran into a lot of people with money. I hear the same things over and over about the stock market. Oh, it's all anybody's talking about. There is no alternative. The comments, I'm parking my money in U.S. equities. I'm being forced to buy riskier assets. All these things concern me. I am not a market forecaster. This market could go through the roof. Everyone feels that way. I'm just here to provide the alternative, sometimes a little bit of sanity for a portfolio. It's very difficult, as we know, in a big bull market to beat the equity market. Where performance shines is when you don't lose money when the market's getting crushed. So, a couple of things I just want to talk about. Yes, the municipal bond rates are at essentially an all-time low, putting bonds on there that have shorter calls, slightly higher coupons, and the whole idea of of being in municipals specifically at this point is for a little bit of protection and a little bit of defense. The best thing about municipal bonds is that if interest rates go higher, and I know that Keith mentioned this in the past, and I've mentioned in the past, you can very easily do a tax loss swap by trading one municipal for a non-identical municipal, but it could be pretty similar, and all the while you're collecting the tax-free coupon. You've created a loss without really giving anything up, and you have an opportunity now to offset some of the profits that you may want to realize in this incredible bull market. So I would not shy away from continuing to purchase municipals, and I would also suggest taking advantage of this risk-on market by shortening your duration. Sometimes I do like to swim against the current. If all the mutual funds want to be in 25-year bonds, let's look at 15 to 20-year bonds. If all the money markets have to be in 1 to 2-year bonds, let's look at 2 to 3-year bonds. Let's go where there's a little bit more room and a little bit more opportunity because you don't have the masses in there. And that's one of the beauties of being able to buy municipal bonds. You can grab the best athlete, so to speak, in the draft. You don't have to pick the position player. And the only other comment that I have to make, I was going to give a quote this morning on Keith Lantern. I decided to give it a week to see what happens in the market this week. But Keith's comment earlier about rational thinking is very challenging at this point. It is for everyone. It is including me, including all the professionals. No one wants to miss out on this. It's one of the biggest things we've ever seen. But that being said, while you're taking some shots, keep your feet on the ground for you always want to keep some powder dry. So with that, I'll turn it back to Keith, and thanks.
Thank you, Brad. Wise words and good perspective when emotions often are running more wild than we may acknowledge. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.